Should I 1031 exchange out of 2 properties I own? Here are the pros and cons and how I think this through. My name is Dan Blackwell. A lot of followers on the channel know who I am, and thank you so much for following. For anyone that has not followed me, I've been selling multifamily real estate here in Orange County for the past 16 years. I am a big believer in multifamily real estate, long-term, and I want to own real estate. So I've been on a personal journey to 100 units, and I'm currently on that journey, however long it takes me. I'm around 30 units right now, and I have a total of 7 buildings. And there's 2 properties that I own that I purchased about a couple years ago that are outside my core operating area. One is a 4-plex and one is an 8-unit building. Now these properties have been producing good cash flow. I've got really good interest rate financing on them for the next 7 years. But what I've learned with having multiple buildings is really time, efficiency, and scale. Those are very important things. So those 2 properties, I'm thinking about, well, maybe it might make sense for me to look at knowing what I could trade into. Could I trade up, consolidate into one building, and have more efficiencies and scale? And maybe I can get into a market that's going to appreciate it a little bit better too. So let's dive in on this. And I thought this would be really good to go through because this is what I'm thinking about and also what I'm doing to help clients as well. And sometimes it makes sense to just know your situation and not do anything, just to stay put, but at least you know you've reinforced your plan. Or it makes sense to then pivot a little bit and do an exchange and to see what's out there. So going through it, the 4 and 8 unit buildings, they're cash flowing. Again, they're low interest rate financing, but I also want to make another purchase. So if I make another purchase, that'll be a 3rd building, and I want to make sure, what if I were to just pull all these back into my main operating area, which is Costa Mesa, where I have the other 5 buildings. Costa Mesa, the cap rates are lower, but the appreciation has been there, and that coupled with cash flow, a nice hybrid approach could make a lot of sense. Plus, I can have one management company run all the assets. Currently, I have 2 different management companies, one for the Costa Mesa portfolio, and then 2 for those 2 other buildings, the 4 and 8 unit in Orange County. I have a different management company, so I pick up some scale. So the first things what I would do, and what I'd tell any investor who's thinking about doing this as well, is what is the value of your properties today? You need to determine the value, so then you can go and look at, okay, what's my net? What would I net on a sale? We would look at paying off the loans if you have any, title, escrow, some ancillary closing costs that you would have, brokerage commissions, to really see what your net is. So you get the property's value, number 1, you get the equity, number 2, and then look at your return on your equity. So every year, some properties I do monthly disbursements on, some are quarterly, some are at the end of the year, I'll just do one big distribution. But what I look at is what is the prior year's cash flow, and then divide that by the equity amount to get your return on your equity. And you can placeholder this on the side. So if you know your return on equity is 3%, then you might be able to get a higher return on your equity if you were to go buy a new asset, especially now that rates are starting to drop. If your return on equity is even lower, 1 or 2%, where you built up a ton of equity, then it can make a lot more sense to consider an exchange. But if your return on equity is higher, 4, 5, 6, 7%, you're probably not going to get that level of return on a new property, because you're going to be getting, if you're getting financing, you're getting a higher interest rate loan potentially. And then also the property taxes. The property taxes getting reassessed at the new acquisition is really what eats up a lot of cash flow and keeps a lot of owners that have held properties for a long term kind of stuck in a good way. It can be good stuck, but you are kind of a little bit stuck there. But there's a lot to kind of peel back, and I can do this in another video. Maybe your after-tax cash flow. You might pick up more depreciation, and that's something I certainly try to do with every acquisition I make. So after the return on equity, I'll start developing my buy box. What is my buying criteria? What are the ideal situations that I want to have in a property? Maybe it's all 2 bedrooms or single story or townhouse units that I really like, or on a great street, because as I mentioned before, and a lot of people know, you can fix the building, but you can't fix the area. So getting in a great street and having the market lift the value of your real estate up versus you doing all the work to improve the asset. If you do a combination of both, that's really where you can make great returns. And then also, are you in a property where you feel that your equity could double in 5 years? That's a big thing. If you're in an area where it's pretty much just cash flow and you have minimal appreciation, you might not hit that double your equity in 5 years. But that's definitely been a goal of mine as I'm buying these smaller properties. If things continue to trend the way that they have been, even with some ups and downs, if you can double your equity in 5 years and then at the end of those 5 years really think about it again and see where your cash and your equity is it best in the current real estate you're in, or does it make sense to roll it up into something else? So developing your buy box. So looking at your equity, for example, if you had $2.5 million in cash and you want to buy in a market where cap rates are in the 4s, under 5%, you're probably going to have to put down 50%. So if you've got $2.5 million in equity, maybe you might want to add some cash, call it to another $500,000, you'd have $3 million in equity. With 50% down, you could go buy between a $5 and $6 million asset. So that's kind of your buy box. You get your location, you get the quality of the product you're looking for, and you get the price ranges that you're looking for. And I kind of widen those out and start looking for a little bit bigger, because you never know, there might be a price adjustment and then it does slide in. You might look at a $6.5 million building and it might slide down to $6 million, and it fits in your buying criteria. So those are really the 4 things that I do when looking at, does it make sense to exchange, right? And let's go over it one more time. It's understanding the current value of your properties, then looking at a net sheet of what you would ultimately net, what would be your net equity, and then looking at your return on equity, and then also searching properties that fit your buying criteria. And I think most importantly, one of the biggest quotes that has always stuck with me is that being lucky is just when opportunity meets preparation, right? Those are the biggest things that you see somebody and they got a great deal and you're like, oh my God, well, they were prepared. And I think even if I don't do anything with these 2 properties and I keep them, at least I'm getting prepped. I'm prepping the buildings for sale. If I don't sell them, then I've still improved the quality of the real estate, right? And that's good for me, even not selling. But I want to be ahead of it, not see a great opportunity and I don't have my ducks in a row, I don't know how much equity I have, I didn't fix up my buildings, I didn't get it right. So I definitely want to make sure that I'm prepared. So that's very important. So let's also dive in on the pros. The pros, management efficiencies, right? As the more and more you buy, it becomes more and more important, especially if you have a day job, right? My full-time practice is helping investors acquire real estate. I still want to be a participant in the marketplace, but I don't want to have that taking up all my time and I can't serve my customers. So I want to have assets and I want to have really good management to where I don't have to focus on it every single day and I can give time to my clients as a priority. So that's maybe more important to me than somebody else that doesn't have that day job, right? Also, I think it is the larger properties. As you start getting larger, you can then scale efficiencies. If I got 3 little buildings outside of my operating area, then that's 3 loans, 3 insurance policies, 3 SB 721 deck inspections, 3 different kind of owner packets from the management company, and 3 of this, 3 that. So I could consolidate that into 1. I could also get a bigger building, maybe 16 units. And then I could get an on-site manager and really get some efficiencies there to where if there's a tenant issue, the on-site manager's on top of it. If there's any trash, they're picking it up. Just things you can't get without an on-site manager. So that's the next chapter that I want to take. But then again, I've got to find the right opportunity, and sometimes those just don't show up. So I'm patient, and this most likely will be a 2025 acquisition, not a 2024, because I'm shooting this video in September, and it'll be hard to pull off. Finding an up leg, moving my down legs, and putting this all together before December, but you never know, so you gotta be ready. Those are the most important efficiencies and getting into just better product real estate. Townhouses, single story would be ideal, but not a requirement, because those are really hard to find, especially you don't wanna have too tight of a focus to where you're not really finding any opportunities. So I'm open to Orange, I'm open to Costa Mesa, parts of Huntington Beach. Those have been markets where I'm already got some boots on the ground and I'd like to double down The cons, right? The cons of selling. Not only going through the exchange, I have confidence I can structure that because that's what I do for a living. So I'm in the driver's seat and I can kind of make that happen. I wouldn't say that's necessarily a con, but there's some moving parts to that. But you got your cost of sale, you got your you're getting out of great debt. I mean, I'm in some of these loans, one's 3.25%, one's 4.3%, and that's fixed for the next 8 years. So they're good cash flowing real estate. So I'd hate to get out of those, right? I'm not dying to get out of those loans. And then I've also got 2 really good properties that I really like. But again, is my money going to do better in this next investment over the next 5 years, or is it best to stay where it is? And you don't really know until you start analyzing real estate. But this is a good first video, sharing really where I'm at, and hopefully some owners can relate to this. And if you're on your own journey and you want me to kind of provide some insights, I'm happy to help you, and we can go through our own journeys and help each other out together. But the part 2 video I'm going to do is really pulling out some opportunities that come on the market and then looking at how does my equity look like in those properties compared to my current situation. So thanks so much for watching this video. I really appreciate it. It's grateful that I can go out to the viewers and be transparent and authentic on what I'm looking for and willing to do, take some risks and put it out there. But I really love the multifamily business and I like helping owners. So if you're in any need for help, reach out. Myself and our team are here for you. Thanks so much. We'll see you again soon.